CME Clearing has defined default management plans for managing a clearing member default event. These plans are designed to minimize losses and ensure the continuity of CME Clearing's clearing services to non-defaulting clearing members and their customers while supporting stability of the broader financial system, blah, 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 blah. So here we go. The CME Group Exchange Rule provides CME Clearing the ability to declare a clearing member in default upon its failure to promptly discharge any obligations. In the event of a clearing member default, CME Clearing may liquidate any performance bond, guarantee fund contributions, and any other assets posted by the defaulted clearing member to cover its outstanding obligations. That could be settlement variation payments, costs, things like that. This includes the costs associated with liquidating, porting, and managing the positions of a defaulting clearing member. So if a clearing member can't deliver the physical metal or can't in any other way support their position, a lot of these positions will get moved to other members which can. So they simply basically cut and paste the trade to another member that can do it. And that's a way that you can prevent agreements from going completely belly up. And what they'll do is they'll liquidate the performance bond requirement and other things that defaulting member had put up to help pay for it. And according as I read 3 or 4 different pieces on the CME Group's website, they've never had to use any of their own insurance fund to deal with a defaulting clearing member. The clearing members always had enough money or interest in the market to be able to pay for any defaults that they've had. So the CME Group has never had a large-scale default of a clearing member, which could at any point in time put the market at risk, if that makes sense. In the event of a clearing member default, CME may liquidate any performance bond. All those things includes the cost of all that stuff. And then they're going to port. So in the event of clearing member default, CME Clearing seeks to port the defaulted clearing member's customers. So they're just going to move those customers from that defaulting clearing member to another clearing member, which may be able to support those obligations. So if the defaulted clearing member supports customer clearing and the customers are not in default themselves, CME Clearing would endeavor to port the customer accounts, including positions and performance bond value, to a single or multiple non-defaulting clearing members. If a bankruptcy trustee has been appointed to manage the estate of the defaulter, CME Clearing would work with the trustee. CME Clearing conducts ongoing default management planning and regular drills, which includes exercises to identify clearing members with similar or complementary customer profiles that may be positioned to accept non-defaulting customers. So they're proactive in identifying who can take the trade if somebody defaults and can't get their position or support their position that they've taken, whether it's long or short. Importing success has increased as a result of CME Clearing's gross margining practices for all unaffiliated customer accounts. In particular, with customer gross margining, CME Clearing sets a minimum performance bond level as a sum of the requirement calculated. And when you see the market get frothy, they increase the margin level. So the CME Group, I think 3 or 4 times in the span of the last couple of months on the exchange has increased for gold, but silver specifically. Some for gold, but even more for silver, the percentage required to put up against the contract. And that's presumably, and a lot of times that slows down trade and can stop a bull market, or it can stop even a short slide, because you're increasing the cost of playing the market, which is going to reduce people opening positions. And we certainly saw that on the Commitment of Traders report, where you had all these positions exiting the market. You had 13,000 in silver, and if you go down here to gold, you had 78,000. Well, that's because it costs more to put a contract on the market. But what it also does is it puts more money in case one of these members defaults. And so if the CME Group sees the trade getting distressed in one direction or another, they increase those margin requirements, which slows the run, but it also puts more money in the system in case somebody defaults. There's a whole auction and liquidation process you can read about, and there's $100 million in a special insurance fund. Let me see if I can get the graphic. Here's the graphic. So there's a safeguards waterfall. So on IRS products, it's 150 million. On other base metal products, it's 100 million. You can see over here of contributed capital between the member groups. That's an insurance fund. So even if a clearing member performance bond is not enough to settle a defaulted trade, the CME has an insurance fund. They say that they've never had to use it at this point to liquidate or to handle a defaulted clearing member on any of the trades, whether metals or other, but it's certainly there. They have a non-defaulting clearing member guarantee fund. They have a guarantee fund sized to cover losses, performance bond guarantee fund. So they have 275% of each non-defaulting clearing member's guarantee fund is general assessment powers, which is the last stage, which is if the clearing insurance fund, the guarantee fund are enough, they can go assess all of the current trading members for an extra 275% of the defaulting member's liability. So the defaulting member was defaulting on $10 million worth of silver contracts. The 100 million would capture it from the insurance fund. Well, it would be paid from their performance bond first and then the insurance fund. But let's say it went to 200 million, like it was a really big default. Well, the CME group can assess the rest of the trading members for the benefit of keeping that market liquid. So there is a whole process here for dealing with one defaulted member taking down a market, or just dealing with the fact that you could have a member defaulting, but it's not the end for the person on the other side of that trade. The person on the other side of that trade may get cleared by another entity because the CME group's going to catch that defaulting member. They're going to take all their money that they put up for performance and try to pay it off. And they're going to move those unclosed positions to other market participants. And in this insurance scheme, the other market participants can get assessed additional money that can help cover a default. So if the entire market defaulted, this would not work. It's an insurance scheme, but there is a robust insurance there in CME Group to prevent a default from taking down one member or a group of members. And there are some fees and things built into that, just so that you know. And then we want to talk about liquidation and the process of liquidating. So that's in section 826 of the rule book, which I'm going to basically, we're going to go down to the liquidation section. We're going to read through. So default by base clearing member, this is really small, but I'm going to do my best to kind of read. I'm not going to read the whole thing, but I'm going to give you a flavor so you understand that there's an entire huge section of the rule book dedicated to default and clearing. So it says if a base clearing member of CME, CBOT, NYMEX, or COMEX, or an OTC clearing member fails promptly to discharge any obligation to the clearinghouse, or becomes subject to any bankruptcy, reorganization, arraignment, insolvency, moratorium, or liquidation proceedings, or other similar proceedings under U.S. federal or state bankruptcy laws, any comparable non-U.S. laws, or other applicable law, the clearinghouse may declare such base clearing member to be in default. And the clearinghouse will post a rule, and they will mitigate any loss caused by such default. They may engage in commercially reasonably transaction. They may buy metal in the case of gold or silver if they can buy it to help the defaulting member with those insurance funds. So even if you needed physical or cash, they have the ability to do that. They can eliminate the risk created by the default, including entering into hedges, liquidating positions in the market, auctioning or selling a portion of the portfolio of the defaulting firm, offsetting book entry positions. In other words, if you're heavy to one side, long or short, they could do a book entry position to kind of help clear you out and use money to clear those positions just to relieve the derivative pressure part of it. They maintain plans for managing the default of a base clearing member. And as you go down, and it talks about how they handle the collateral that the default clearing member is putting up per contract, and then how they apply that. And they've got rules 804, 8F05, all of that to deal with that. So there is a huge section, and there's allocation of assets, management of obligations, payment obligations, losses are finalized, clearinghouse obligations, so on and so forth. I mean, it is extremely detailed on how they do this. I wanted to explain a little bit about deliveries on the market so people understand, and talk about the delivery process. So there are deliveries, and then there are loadouts. Loadouts when you take the metal off the exchange. So the 4 million ounces of silver that I highlighted at the beginning of the program, that was loaded out and actually taking off of the exchange. Delivery is basically saying, you have metal over here in this Comex approved depository. I want it, put my name on it, but I'm going to leave it there just because it's already there and it's safe, and I can pay those storage fees and I don't have to actually move the metal. And so that takes it out of registered to eligible, but it's still in the Comex approved depository. That's delivery. So delivery does not imply a physical move of the metal. That's the loadout, which is the next step. So sometimes when you take delivery, it's just people passing metal back and forth. Maybe somebody needs that metal to guarantee some position elsewhere in the market, so they're going to leave it on the Comex. Or maybe they eventually want to take it off the Comex and use it physically, but why remove it and move it there to your place and then move it somewhere else? I mean, it's just going to be expensive to move. So a lot of times they'll leave it there. But here's the delivery process. So it says the CME Group exchange rules provide CME clearing the authority to declare a clearing member in default upon its failure to promptly discharge its obligation to a clearing member for bankruptcy and default. And the event of default, CME may liquidate performance bond, all that kind of stuff. And the financial safeguards waterfall, which you've seen, which were the things that I showed you, the insurance and the assessment ability and things like that. Delivery process for a futures contract with physical delivery. Pursuant to Rule 716, Clearing members are responsible for ensuring account owners and physically deliverable contracts have the ability to make or take delivery. During a deliverable futures contract delivery period, accounts holding open positions can incur delivery obligations. A short position holder must be prepared to deliver the underlying commodity, while the long position holder must be prepared to take delivery of the underlying commodity and pay the full delivery value. And they go on to outline ways or scenarios in which the longs can't actually take delivery. So there is a settlement process. There's a day one, a day two, and a day three. There's a delivery performance risk, which is what the CME group works with. There's a delivery margin, and that's a margin you put up to guarantee that position. And then there's a whole failure process and rules for that. And if you go deeper into the rule book, as I looked at section 7,